global markets sold off sharply and entered correction territory following news of the coronavirus spread in South Korea, Japan, Iran, and above all, Italy. 40 countries have now been affected. Safe havens advanced further with U.S. 10-year Treasury yields hitting 1.20% or close to all-time lows, and bond yields at minus 0.58%. Gold pushed higher to around $1,635 per ounce or close to its 2012 high, while copper, the barometer for industrial activity, tumbled 12%. In a reflection of investor stress levels, implicit equity volatility surged to above 39% on the U.S. index, or levels last seen when markets corrected in February and December 2018. On the Euro Stoxx 50, volatility hit 34%. WTI oil fell below $46, triggering fears the dip in activity was worse than initially expected and leading some European officials to suggest more budget easing. Worries that economic stoppage could lead to a technical recession were the main driving force behind the market fall. Any quarantine procedures similar to China's could have a marked impact on economies as European growth is weak and therefore vulnerable. The epidemic is affecting manufacturing delivery times as well as transport and tourism. As a result, upbeat Eurozone PMI data are misleading. We should, however, bear in mind that this correction comes after a strong market rise that had taken valuations to above their historic mean. Markets could be in for a short-term correction, but we are already 13% below the recent Euro Stoxx peak and 12% below S&P 500 highs. Bond markets have reacted more than equities, a divergence of sentiment that logically reflects this sudden spike in risk aversion. Looking further out, we will have to assess the real hit to economic growth and company activity, a very tricky exercise at the moment due to lack of hindsight and the ongoing spread of the virus. What is certain is that the interest rate and liquidity environment will have to remain ultra accommodating, certainly providing some support for asset prices. But with a shock to the supply side, the support from strong demand could well be futile in short term. In other words, we need to know if we are confronted with the structural supply and demand shock or a merely fleeting event. Economic data and company results will therefore be scrutinized in the coming weeks and months. Elsewhere, and as we expected, China's economy seems to be recovering, so the worst might be behind us. Central bank support is still significant and expected to remain so amid such poor visibility. Strong liquidity inflows could, over the short term, tempt traditional investors to step back into the equity market. With the MSCI Europe NR down 12.5%, the panic comes at a particularly busy time for earnings reports. Due to market nerves, mean companies escaped unscathed. And round off the week, tensions between Syria and Russia compounded fears over a pandemic, making it very difficult to navigate markets. But there was some upbeat earning news. After several profit warnings in 2019, Thales said book-to-bill was above 1. Peugeot's cash generation hit record highs. Sales and free cash flow at Rolls-Royce beat expectations. Carrefour's EBIT in France rose 15%, suggesting restructuring in the country was on track. In downbeat news, AB InBev fell sharply due to a marked drop in like-for-like EBITDA and weakish guidance for 2020. Munich Re's 2019 figures were in line, but the fourth quarter was disappointing. The group confirmed its $1 billion share buyback program. Results at Danone, WPP, and Reckitt Benckiser were all disappointing. Reckitt wrote down the value of Mead Johnson, which was acquired in 2017. The activist Elliott Fund bought a stake in Arkema, which said it wanted to reinforce its exposure to specialty chemicals. The market had a whirlwind week due to the coronavirus epidemic. Services PMI data were also a little soft. The sell-off began on the previous Friday and then accelerated as long-only funds followed from systematic strategy selling. Up to Thursday's close, the S&P lost 11.7% over 5 days and 7.8% year to date, its fastest ever correction. Defensives like utilities, consumer staples proved more resilient, but still sank 8%. Energy continued to amplify the trend, down 17% and more than 25% year to date. Valuations sank so much they flirted with 100-year lows. This year's U.S. elections also played on sentiment. Bernie Sanders confirmed his lead in the Democratic primaries after former Vice President Joe Biden's poll ratings collapsed following the Iowa caucus. Markets are keen on Sanders winning the Democratic nomination as they think he has almost no chance against Donald Trump. Following Wall Street's sharp decline, Tokyo stock prices also lost ground on fears the new coronavirus would spread further across the world and mounting worries over a global economic slowdown. The Topix tumbled 6.33% for the week. All 33 TSE sectors posted negative returns, with air transportation, mining, securities and futures, and marine transportation among the worst performers on slowing tourism and falling oil prices. The government's request to cancel big cultural and sporting events also raised concerns on a hit to domestic consumption and a demand for services. 2 virus-related names were picked up by speculative investors. Canon rose on news it was developing compact virus testing equipment at its medical equipment subsidiary. Fujifilm Holdings hit a record high when the government approved Avigan, an existing anti-flu treatment for the new virus developed by its pharmaceutical subsidiary. The MSCI EM index was down 4.9% as at Thursday's close on mounting fears over the economic fallout from the coronavirus global spread. China postponed its annual legislative meetings due to COVID-19 and started implementing targeted tax cuts with VAT exemption for small-scale taxpayers in Hubei province. Other parts of China reduced to 1% from 3%. Beijing also targeted credit and liquidity supplies to SMEs with loan growth target to be hit in certain cities, pledging a 5% cut in electricity prices for industrial and commercial businesses and a reduction in urban land use taxes. Chinese equities had 8 consecutive days of trading volume above 1 trillion renminbi. On the corporate side, Wuxi Biologics and Vir Biotech said they were working together to develop antibodies to treat COVID-19. Weibo's results were in line, but the company said revenues in the first quarter could fall 15 to 20% due to the coronavirus. To stem the economic slowdown, the Hong Kong government adopted an expansionary fiscal stance with a record high fiscal deficit projected at 130 billion Hong Kong dollars, or 4.8% of GDP. In South Korea, coronavirus infections jumped to more than 2,000 in 10 days, resulting in the country's infectious disease alert rising to its highest level. The government announced a $13 billion emergency financial support plan, which includes gift vouchers and financial support for households. Well, that's all for today. Thank you for watching. Subscribe to our channel to track the market pulse and get the latest economic data. Good luck trading.